As you can imagine, we're having lots of conversations with homeowners right now who are excited that rates have come down, but they are definitely debating in their minds, do I refinance now or do I wait for rates to come down and get lower? So we're going to look at some aspects of that question, hopefully give you some frameworks to be able to decide if now's the good time or do you wait. My name's Miles Pitcher. I own Superior Lending. Been in the business 23 years now. So we're going to look at current rate environment. We're going to give you some factors to consider when you refi, and then we'll give you some tools in deciding to help you refinance now or wait later. So check out this chart. This is a chart of the 10-year Treasury as of today, 9/27, and this goes back 1 year, and you can see that a week or so ago, we were at our lowest rates in the last year. We're still very, very low. That means there are a lot of people who have higher rates than where we are today. And so we're thrilled with the rates that have come down. We have had the Fed meet on 9/18, and they lowered the Fed funds rate by 50 basis points, which was expected, and it was priced into our mortgage rates. I want to remind you that our mortgage rates move independently of the federal funds rate. So their decisions, their actions do not directly impact our rates. In fact, the day that they lowered 50 points, we had that already priced in. Our rates even got slightly worse on our mortgage rates. So just as you hear talk about Fed funds rates, just understand they do indirectly affect us, but we will move differently in the mortgage rates. We move on news and economic data and things like that. So, and as a reminder, rates are not going to drop automatically. It's going to be over time, and it will not be a straight line. There are going to be some zigzags, but for sure we are moving into a rate cutting cycle. So we do expect lower rates. So this is a cool table. I love this because one of the things I think people need to understand is how much, with a rule of thumb, do I need to look for in rate improvement for it to be worth it to refi? So I've kind of put together this little table based on your loan amount. How much do you need to see improvement in your interest rate to be worth it to do it? Obviously, a higher loan amount, $1 million, does not take much to be able to improvement like 0.13% in improvement in interest rate for a refi to be worth it. So check that out. Pain points is an interesting question because what pain points means is you're buying down the rate. On pain points, the thing you need to look at and measure is your break even. So if it's going to cost you $6,000 to buy down your rate by 0.25%, and it saves you, how much does it save you? And you divide that into 6,000. That's how many months it's going to be for a break even. What I get fearful of is people who pay points, but then rates drop and they refinance, and all that money they spend on paying for points is a total waste. So make sure you know your break even on paying points. We don't like building into the loan the closing costs associated with a refi. We do what's called a strategic refi, and we really try hard not to add any money into the client's loan balance. What we like to do is ask the client to say, hey, we'll take care of the closing costs if you can cover the escrows. And usually that works out really, really good. As a lender, we give a credit for that. The escrows they cover, and usually they're getting a refund of escrows back from their old lender when they refi. So that way we're not bumping up somebody's loan amount. We've talked a little bit about break even, but we'll talk some more about it here in a minute. So some considerations. I believe I believe if you do the math and you look at your refinance and you're saving the money and you're doing it in such a way you're not adding money to your loan balance, it's a good thing to get it done. I'll show you a tool here in a minute. We do believe in this rate cutting cycle that we could be 12 months, 18 months, 24 months before we reach the lows that we are going to reach. And again, rates are going to be moving all over the place, up and down as we go through this. Okay, check this out. This is really cool. This is new for us. What we have here is a tool where we can put in and say, what is your risk of waiting? So I know that's kind of small, but that says 400. We're putting in our original loan amount, 400,000, 30-year loan. Let's say you're in an FHA loan and you closed at 6.5% on that. Now your loan balance is at 397. Currently, we're at 5.25 on our FHAs. And hypothetically, you believe that we could get to 4.75 in the next 6 months. So how does that math work out on waiting for that extra 6 months? So the cost of waiting is going to cost you an extra $2,000. So if you look down here at the bottom of the chart, you can see the current loan and what the principal and interest payment is, the refinance now, and it would save you $336 per month. Or you wait another 6 months and it saves you $457. So the difference, the $121 difference in payment right there between now and down the road 6 months, means that you have a break even of 17 months. So just some numbers to help you to realize and determine, is it worth it to wait? Now, yeah, $2,000 is some nice savings, but yeah, you could decide whether it's going to be worth it or not. Oops. All right, here's my tips on refinancing. So number one, make sure that you have a float down built in with your lender, meaning what happens if rates get better during your underwriting process of your refinance. The reason being is we are in a day and an age where things are very volatile, meaning rates can move fast up or down. And if they drop significantly during your underwriting period, you should have a lender that allows you to float down your rate and take advantage of that lower rate. It has to be significant. So if it's just a little eighth of a percent, that's not worthy of a float down. It needs to usually be about 3/8 of a percent, 0.375. We've talked about break-even point. Understand what your costs are in the refi and how many months it's going to take in savings to recoup that. Also, you should look and understand, can I drop my mortgage insurance? If you're in an FHA loan, sticking to FHA loan, you cannot drop your MI. But it may make sense to refi from an FHA to a conventional if you can get rid of that MI. Or if you're in a conventional and now you have a bunch of equity in the home, maybe you finished the basement, home values have shot up. Now you can either get a very nice reduction in your mortgage insurance or drop it. Talk with your loan officer, make sure you are in the right loan program. We've had many people that we have found were in conventional loans, and based on their credit scores, they should have been in FHA. Additional savings can be found by making sure you're in the right loan program. And I will tell you this, there is no such thing as a no-cost refinance, right? So there are always costs with the refinance. You will either end up paying them by money out of your pocket or covered by a lender credit, and that lender credit is made possible by having a little bit higher interest rate. So make sure you understand that the closing costs have to be paid and they will always be there. There are loan refinance programs that minimize those, such as an FHA Streamline or a VA IRRRL or a USDA Streamline, but closing costs still exist. Let me know if I can crunch any numbers for you or help out. This is how you can get to my team. Happy to help you evaluate things. Thanks for watching my video.